Hi, everybody, and welcome along to the Mint Monthly Update for the single sector funds. Today it's myself, David, and fellow portfolio manager John Middleton, and we'll give you an update on the month of April that was. So just rolling through here to the first page, thought I'd touch on one of the actually more of the macro events that's been closely watched for all sorts of reasons at the moment, but realistically, it's the inflation that's driving a lot of what the markets are thinking at the moment, and a key one there. We did get an update for the Q4. Apologies, Q1 26 inflation. And again, it's sitting at the top end, and this is obviously, to give it context, before we see the full pass through from any of the fuel impacts in Iran. But what we're really seeing is the fact that even outside of what will be some inflation come through from fuel and diesel price increases, is that even underlying and what you'd call core inflation continues to remain elevated and sit at the top end. And so, if you look at the chart on the left, this is ASB, and it's not too different from a lot of the banks and many forecasters. We are expecting a pretty large bump up to the almost 5% level in inflation over the next couple of quarters as the diesel prices roll through. So that's certainly going to be a key piece of it. But more of a focus for the RBNZ in terms of impact around raising rates is around that core level. And then if you look at core inflation at the moment, it's sitting at the high twos. So still probably higher from what the RBNZ would like. Certainly with the OCR sitting at what would be called a supportive level currently. But if you look at the chart on the right, in terms of tradables, which is driving a lot of the current inflation, it's really not just a one-trick story with fuel. And obviously that will be what accelerates in the next quarter or two. But we are looking at food as well as a pretty meaningful portion of inflation. And of course, as we know, with things like fuel, if that becomes embedded or lasts for a little bit longer, we will start seeing that permeate through other areas like transport and food. So it is something I think we're keeping a close eye on, but certainly is unhelpful for the macro conditions in this country, especially, but obviously in a global context, we've seen a bit throughout the rest in Aussie and rest of the world as well. But just rolling through to the funds themselves, the New Zealand SRI Fund had a reasonably solid month, positively in a month that was pretty flat for the market. The NZX was down just fractionally, but it was an interesting month really in terms of what drove the returns. In general, it was a bit more of a back to yield in terms of some of the defensive names performing pretty strongly. That included a few of the energy companies. In fact, most of the gentailers, which is the Mercuries, Meridians, and Contacts, etc., had a pretty strong month, and more so Genesis. But again, we did see a bit of a sort of normalize of some of the cyclicals. I think some of these cyclicals have done quite well on the expectation of a NZ recovery, whether that be housing, whether that be just economic activity, and obviously with the fear of Iran and the Middle East and what's happening there, I think that took a bit of a reversal. We saw that switch round. And in terms of the wider names, I think the main ones of the month to talk to really are Infratil and A2. Infratil, obviously, to be fair, start of this month has already had a big move on the back of a large contract, but the move through April was really just a continuation of the positive track for their key asset CDC, which they'd had an investor day at the end of March, and that sort of rolled the positivity around a little earnings upgrade rolled through into April. Additionally, over April, we did see that key asset CDC get a credit rating, which is very helpful for its future funding of all its projects. And then on top of that, we did see it continue to perform well. And as I mentioned, early this month, we'd actually saw a ginormous contract signed by the business for 550 megawatts. In terms of context, that's about the same size as about 40% of all installed data centers in Australia. So when I say it's large, it certainly is. That's all with one US customer, so pretty huge magnitude of upscaling. And so what that really means is it's gone from a business, an Infratil, that's around 600-700 mil of EBITDA this year, rolling to almost over 2 billion of Aussie EBITDA once all that is deployed. Now, on the call itself, while the CEO can come across quite bullish, he continues to see opportunities for additional contracts on top of this. So this is a name that we've been excited about to own in the fund with Infratil, and is the largest position in the fund. So it's certainly, while it was helpful in the last month, it continues to track well this month, even though it is early on. But the other big swing of the month in the other direction, of course, was A2. Traditionally an underweight in our funds, and it proved pretty helpful this month. And that came across a couple of wee little issues. Firstly, they did provide an earnings downgrade early in the month, and this was across a couple of reasons. This was a supply issue, partly starting a period with a bit of low inventory across some of its key English label product. But additionally, where we came to see the bigger downgrade was really around the ARA, and this is really an issue with cellulite, which is a toxin that can persist within some of the ingredients. And of course, we've seen a clampdown from the Chinese authorities around testing for this infant formula. So what this meant in terms of a double whammy for A2, it's meant that they're sitting in a period with low inventory as they try to rebuild from a few issues at Synlait. And then overlaying that, we've now seen the Chinese regulator limit and force testing on product into the country. So it's really pushed back earnings, and we saw that with them cutting their EBITDA margin and revenue expectations for the year ahead. There's a lot of questions in the market at the moment around, how long does that persist, and how quick can they get the channels filled again, especially as we head into June, which is one of the decent sales periods. But on top of that, unfortunately, it hasn't gone well for A2. We've actually seen a small recall out of their US business. Now, I would think this highly related to the existing downgrade around the cellulite toxin update. It's only 60,000 cans for context, reasonably small, but of course, the worry, and we've seen it in some of the social media accounts in China, is that it permeates to a negative story to the brand, and that's really where the fear is, and the A2 share price, and why you've seen it derate massively. And I guess the chart in the picture there is showing A2 has been priced for perfection. It's been priced at a very high multiple in our view. One of the reasons why we've been underweight, and and what that means is when things slip up, and this has been a reasonably sizable slip up, it's certainly hit the share price hard. So we've been reconsidering our position, and certainly it's one name that we've been adding to on this weakness as we reconsider. And I will now pass you over to John to run through the Trans-Tasman Fund for the month of April.
Yeah, thanks, Dave. Echoing sort of Dave's comments, the Australasian fund actually had a better month, comfortably ahead of benchmark. And again, most of that upside came out of Australia. Dave's sort of mentioned the two significant New Zealand moves, obviously being underweight A2 and overweight Infratil helped a lot. And again, the only other thing I'd mention in New Zealand is obviously the concerns about stagflation, et cetera, weighed on those stocks with house prompt market exposure, and particularly the retirement names. And Somerset, for one, had a tricky month again. But it really was about Australia, and three or four names in particular. The interesting thing is both SRG Global and Macquarie both had very good months. SRG, I think, can be explained by index changes. It basically went into the ASX 200 a month ago, and bizarrely, or from a flow perspective, we've sold down having entered, and bounced a month later. So nothing specific to them, but a sort of technicality which we took advantage of, and had a good month, up 17%. Macquarie, again, generally benefiting from markets. Obviously, the banking side of the business, which we don't talk about much, it's only about 13%, continues to grow well. No real surprises there. But I think it's more the commodity side of things, where it's a business which is quite boom and bust. It's had a number of very, very strong years, and unfortunately the last couple of years have been a bit weaker. But one stock that should benefit from all the volatility, particularly around energy, is Macquarie. And as we've just had the results this month, it did, and obviously traded reasonably well into those numbers. Another couple of names I'd just mention in passing. One would be Telex, which again had a solid month, let's say, and basically some benefit from ongoing milestone success. And then finally, just to flag that the technology-related names in Aussie, particularly WiseTech and Xero, had a better month. Obviously these guys have been under pressure from the AI threat for quite a while, 6-9 months now. And again, I think we're very confident that they have moats, and the underlying businesses will probably benefit from AI in terms of cost reduction rather than in terms of a fear of market share loss. But again, both those names had a better month. Switching over to the property fund. Really, again, a similar story there. Obviously, property sector in general was weighed down by rising yields, and again, they didn't go up any further, so the index had a better month. Similar to the Australasian fund, it was the Australian names, in particular Goodman Group and Charter Hall, which were significantly more dynamic than their Kiwi counterparts. And again, the Kiwi market was sort of broadly subdued, but generally not huge surprises, and nothing particularly specific. Again, Goodman is essentially an industrial REIT, but does have basically a strong position in data centers going forward, a slightly different story to Infratil, but I think benefited from ongoing signs and confidence that the rollout of data centers over the medium term will be highly beneficial to those involved. And again, Goodman was probably the main beneficiary of that. Just looking at the market, I thought the table on the right is quite interesting in that we get quite fixated about New Zealand and Auckland versus Wellington, but hopefully this picture gives you a little bit more information about the wider market. And I suppose that the thing I'd like you to take away from the top and the bottom chart is that actually New Zealand ranks reasonably well. Certainly the spread over the bond yield in pretty much all categories is amongst the best within the Asian region, particularly in Auckland. But certainly standing in good stead versus our Australasian counterparts and even further afield. And then also that the yields that we are getting in these markets again are towards the upper end of town. And so while we have seen the sector being impacted by concerns about rising bond yields, et cetera, I think the reality is, as we've spoken before, is that actually the underlying fundamentals are solid. Yes, in office there is some concern about vacancy in AI, and again there's a little bit of economic pressure creeping into things like industrial, but for the most part, the end markets remain robust, and most of the listed sector within the New Zealand market is focused on that prime area of the market, which tends to fare pretty well across the board. So again, just echoing comments of previous months, the slightly tougher Kiwi macro has caused us to move back towards those stronger, more robust assets, in particular the industrial side of town. But fundamentally, I think we're reasonably comfortable with the sector as a whole, and again, think that the yields are sustainable at current levels. Anyway, I hope that was of interest. If you have any questions, as usual, please drop us an email at info@mintasset.co.nz, and we look forward to talking to you in a month's time.